Hi everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in. We're continuing our talks about the history of the Federal Reserve, and in the last video we introduced the concept of central banking, and we talked about how in the early years of the Republic there were several institutions that had acted as quasi-central banks. Today we're going to talk about the banking system that persisted in the 50 or so years prior to the Federal Reserve. And it's a good subject because it builds our way up into the reasons why financial and political reformers eventually founded a central bank. So after the expiration of the charter of the Second Bank of the United States, this is in 1836, the country went into a period known as the free banking era. And in the free banking era, the individual banks themselves, these are state chartered banks, were actually the institutions that were issuing the currency. That currency was generally, or was supposed to be, converted into gold, so the country was on a de facto gold standard. There was a lot of fraud in this period, but that's how the country's currency system operated. Now, on April 12th, 1861, of course, the first shots are fired in the American Civil War at Fort Sumter. And as the war drags on, the Union government has to figure out a way to finance it. And wars, of course, are always costly in terms of blood and treasure, but the Civil War raged on for far longer than anyone anticipated. In 1862, Congress passes the Legal Tender Act. And one of the things is this act introduced something called the greenback. This is the first kind of true paper currency in that it was not immediately converted to gold on demand the way that currency had been before. In the next year, in 1863, Congress passes what was then the National Currency Act. This later became the Banking Act of 1863. And this was an attempt to try to increase the demand for greenbacks, because at this point, greenbacks are still competing with state currency. And the 1863 legislation applies a 2% tax on state banknotes. This legislation also creates the Office of the Comptroller of the Currency. This is the first federal regulator of the banking system. So that's really the lasting impact of that legislation. Now, in 1864, in summer of 1864, June of 1864, Congress passes another National Banking Act. And this is the legislation that becomes the most important for the financial system up until the founding of the Fed. So what the 1864 Act does is three things. First, it creates a three-tiered system of reserves. Now, of course, reserves are the amount of deposits that that banks have to keep as opposed to lend. And this three-tiered system creates three buckets of banks. One is money center banks. Initially, this is just New York. Eventually, it becomes Chicago and St. Louis. And then it has reserve city banks that are spread. These are large regional markets spread throughout the U.S. And then you have country banks. Now, the reserves are different at these different levels, but the impact is that essentially reserves end up highly concentrated in these money center cities, particularly in New York. So the other thing that this legislation does is it imposes a 10% tax on state banknotes. And this 10% tax essentially creates a national currency because it makes it prohibitive for individual banks, these state chartered banks, to issue their own currency. So this is the start of a real national banking system. And then the third thing is banks still issued these federal notes, and they had to keep 90% of their note issuance in U.S. Treasury debt. And this is one of the most important things to keep in mind. So the money supply becomes tied to the supply of US government debt. And as we'll see as we get into the founding of the Fed, this is a major issue. The founders of the Fed are looking to create a scenario where you have a money supply that is a reflection of actual production of goods and services and not just tied to US government debt. So these are the two things that the national banking system really does, is it creates what they called an inelastic currency, that is a money supply that is not tied to commerce. And then it creates a system where reserves are highly concentrated, very often in the wrong parts of the country. And in the next video, we're going to talk about some of the financial panics that arise in the national bank system. Thank you for tuning in. We'll see you next time.